Thank you everyone for being here today with us. My name is Laura Ivy Blessing. I'm with Keller Williams Realty. And you have joined us for insights on capital gains taxes. And that's really confusing for a lot of people. So I'm really glad that we're doing this today because I have had a lot of clients reach out and we have sellers who are sitting on more equity in their homes than the history of the US has ever experienced. And some of them are afraid to sell. They don't know what to do. They're going to pay a lot of taxes when they do. When they die, their inheritance are going to pay a lot of taxes. There's just a lot of questions around this. And so we wanted to have this to prepare people, whether it's their home they live in or it's an investment property, what they can do to decrease or avoid paying capital gains. We got to pay some taxes. We know that. But what are the smart strategies that we can do to prepare now if you're going to be selling this year or sometime in the future? And we have special guests here. One of them is a past client and I've known for many years, and they are with the company Momentum Private Wealth Management. We have Austin Hahn and we have Don Rudy here. You help investors. You also help people just with all types of wealth management, correct?
That is correct.
Tell us more about your services and maybe even how you help people with capital gains.
Sure. Thanks for having us on. This is great. Momentum Private Wealth Management is a registered investment advisory firm located right here in Cedar Park. And we focus primarily on the traditional investment advisory services that you might find with an investment advisor, but we also do comprehensive financial planning. And so most of the time when we're doing financial planning for our clients, we are having discussions around their real estate and their potential tax consequences. We're glad to be here.
Awesome. Do you have an example of, first of all, what is capital gains tax? Let's just start at the very basics. These people are confused.
So when it comes to real estate, your potential capital gain is essentially the difference between how much you paid to purchase the property and how much you sell it for. It's a little bit more complicated than that, as you can imagine, but that's generally what your gain is in that property. The big issue that most people get into is they don't realize the nuances of what goes into that calculation when it comes to real estate, because there are things like capital improvements to the property, which adjust your cost basis. Your cost basis is how much you paid for it. So that may increase your cost basis, thereby lowering that potential capital gains. Acquisition costs or selling costs that are attributable to the seller of the property, right? There's a lot that goes into this that can affect your capital gain and therefore your final taxes owed if you do owe any in the loan.
Got that. Understood. And I'm going to interject because you said we needed to make some disclosures here, right? Because we are not tax accountants here. You're not accountant, and you're a financial planner.
Yes. Yeah. Thank you for that. I am a good financial planner and I've earned my marks. I earned my marks in 2011. But what's really important to understand is we don't file taxes on behalf of clients. We do tax planning, which is very much centered around this capital gains discussion we're having today. But nothing in this webinar should be construed as advice. We want to make sure that this is an informational session, and that if anyone really does have any questions, they need to consult with their own financial advisor, because there's some very nuanced things that we're going to discuss today, and there could be some big consequences. So again, nothing's advice. We're not implying anything. We're just here to have a nice discussion.
If you were concerned about this, who else should you talk to about it? Accountant, attorney, financial planner? Who should you have on your team here?
Maybe all the above.
Real estate agents?
I'm a big believer in just gathering data, right? And having information at your fingertips before you make any decision. And it's all about making an informed decision into what's going through. Selling a house is a very major financial transaction. And we have run across instances where people have shot first and then aimed, right? As the saying is, get into a transaction and then say, okay, what did I do? How do I make sure we correct this? The point to that is, if you have a CPA and you work with a CPA, they're a great person to have that initial discussion with against. If I sell my house today, I think it's worth this much. do you think there might be an applicable gain, the tax on the gain that we have? And I'll go into the nuance there in a minute. Your financial advisor is a perfect person to have that discussion with. They usually have a little bit more of a pulse on the market, what's going on, and can run those calculations for you. It's all best guesses, of course. We do it all the time. And I would say an attorney, potentially, if you are getting into anything that involves estate planning or the titling of the asset, or if you're trying to do something like a 1031 exchange, you definitely want to seek out the help on that. Again, you want to make sure that the right people are helping you make these decisions. And the psychic, for sure. Who knows? You got to get a good gauge on what the market's going to do. Although I've never had a client use one for that purpose. So
I'll read your tarot cards later. Let's focus on the homeowner, not the investor at the moment. And so what should they focus on? If they're seeing a lot of equity, and what can they do with this equity? If they sell it, they might pay some capital gains. What are some smarter options that are available to them if they didn't want to sell and they wanted to use the equity in a smart way?
So I'll take one step back from that and just say the IRS has a pretty generous exclusion built into the tax code when it comes to the sale of your primary residence. And so there's two things you really need to understand. One is your tax filing status, whether you're married, filing jointly, or single. And two is how long you've lived in that property as your primary property. If you've lived in that property for 2 of the last 5 years, you check that box and qualify. And if you are single, filing single, then your exclusion, your capital gain exclusion is $250,000. The downside is that this hasn't really been indexed to inflation over the years. It's been a fixed number. So maybe 20 years ago, it captured the majority of people, unless you were living on one of the coasts. But most people fall within an exemption of $500,000 in capital gains. Therefore, the majority of the gain that they realize when they sell their home is not taxed at all. Right. A lot of clients don't actually realize this. We run the calculations. They come in thinking they might end up paying 6 digits in taxes based upon the value of their home. The reality is it's usually a lot less. There are some nuances to that. If you bought your property in 1980 for $40,000 and you're selling it for $1 million, you have quite a gain in that property. Half of it's going to be exempt if you're married filing jointly, but you're going to pay in taxes on the rest of it. We always talk to our clients and say, what's the purpose of you selling this property? And what options do you have instead of selling that property? And sometimes people are downsizing, right? We see that a lot. Sometimes it's for financial reasons. They have built up a very large base of equity in their home, and it's very much a large part of their net worth, but it's not liquid, right? Mm-hmm. In lieu of taking a reverse mortgage or home equity line, they're looking to sell that property. It could be health reasons, or it could be they just want to relocate and move states. The reason, and this is why we get into the personal, comprehensive financial planning aspect of it, is what are you trying to accomplish? And are there different ways that we can go about doing that? And I'd say the majority of the time, selling that property makes sense. They need the liquidity, or they don't want to be homeowners anymore, or they're trying to downsize and they need that money to go ahead and downsize into that property. Other times, some clients may make the decision to actually keep that property and turn it into an investment property, which has its pros and cons, not just drawbacks.
Yeah.
You get to be a landlord.
Which everybody should experience once in their life. It's like waiting tables. Everybody should wait tables one time in their life. Everybody should be landlords.
Yeah.
It's humbling.
I think Dawn says it best in our meetings. She says, it's not really passive income. You're very much actively involved in this. If you want to go change a toilet at 10 o'clock at night on a Sunday or whatever, then by all means, you can pay someone else to do it for you, right? So that is something that you need to take into consideration if you're going to turn this into an investment property. We say it's black and white. It is a personal, private home that you're doing whatever. And if you're going to turn into an investment property, you have to have that mindset switch to say, this is a business now. You treat it as a business. So there are certainly some steps that you need to take to protect yourself, protect your renters, and whatnot.
For sure. I have had clients in the past who have moved out of the home that was their primary residence, and then they only rented it up to the point of 5 years, and then we sold it. So that's one strategy that we use. Then I recently had a client that she bought her home in the 1980s. She was downtown off the South Congress. We now work with someone because right now in this market, if your home is not updated and it wasn't completely updated, you're going to get an investor level offer if you list it. That's just how our market is right now in Austin. And we ended up working with a company that will do a joint venture with her, but they close on the property first at a lower price, which helps with capital gains. And then she does have to pay income on the JV after. So that's in progress right now.
So if you don't mind, why don't you go in a little bit deeper on A, what an investor level offer is, and B, the difference when you brought up the JV?
That's a good question. Normally, when you're listing a property for sale, you have the investor level, which investors are going to pay the least amount for a property because they've got to put the most amount of money into it in order to make a profit when they sell it. We have people who tear down properties here and rebuild them. There's a whole group of people here in Austin who it used to be very hard to find those opportunities, and they're coming up now more. The reason they are is because when you list a home for sale on the market in a normal way, let's say normal, if it's move-in ready or you could move into it and you get someone to finance it, then you could probably get more than an investor would pay. The buyers are pretty picky because they're paying more per month, right? Because the interest rates are higher. So the home you were paying $3,500 for a month, they're going to be paying like $6,000 a month for, and they want everything done. So they are rejecting anything that isn't move-in ready or doesn't look like a new home because the new home builders are just killing it, record breaker months. And so the buyers are like, I'll just go new. And the resale market is struggling. And that's what has happened, why you're getting an investor level offer if you don't make updates.
So I've got a question on top of that. In your experience, someone who comes in and purchases a property as an investor, do you see them typically flipping that house, or are there investors that are building investment property portfolios and holding them for the long term?
For a while, the flip game in Austin was strong. And I would say probably about 10 years ago when all the investors came in and our prices went up so high, it was not as strong. Flipping in Austin, you were not going to make very much, maybe 10, 20,000, which is a lot when you're looking at 3 to 4 months of capital involved. You've got to find a needle in a haystack to make good money on a flip here. So the investors here are the ones who are willing to work within that margin, and they do it at a higher level. They're doing more of them.
I asked because the time that the investment is held directly correlates into whether or not you're looking at a short-term capital gain or a long-term capital gain. In the eyes of the IRS, whether or not this is your personal property, this is just normal capital gain discussion, whether it's a stock or a house. If you own it for 12 months or less, then it's considered a short-term capital gain. And you pay your marginal tax rate on that, which means whatever your top tax rate is on the income that you've earned for that year, whatever that gain is going to be tacked right on top of that. And that's the rate you pay. The long-term capital gain rate is a much more favorable tax rate, right? And there's actually three. It's 0% for some filers. You can generate a certain amount of income and remain under that AGI or adjusted gross income and qualify for that rate, which is great. So we see that a lot in seniors maybe that aren't generating a lot of income. You have the capacity to generate some capital gains and pay no taxes on it as long as it's long-term. 15%, which is the most common. Most people fall into the 15% bracket. So 15% is usually going to be a lot lower than anyone's marginal tax rate. So it's a better, more favorable rate. And then 20%. And the 20% is really for those really high earners that are generating a lot of capital gains and a lot of income in both their job and equity compensation and whatnot. The point to all of this is the IRS really wants to incentivize you to be a buy and hold type of investor, whether it's in stocks or for real estate property purposes. And they're trying to incentivize you to do so by dangling a lower tax rate on those potential capital gains to these flippers, right? That's part of their calculation. And you probably know more than I do on this, is just saying, hey, we generate $20,000 or $30,000, but we can sell it in 2 months. I pay top dollar tax on that, but we're still taking home 75% of that, right? It's a very interesting conversation, but that's usually where we start is how long ago did you buy it?
Awesome. I recently bought my first investment property and experienced the magic of cost segregation. I did not know about this. We need to teach our children about it.
Yeah, go into detail.
Now, I'm just saying, I would have probably bought an investment property a lot sooner had I known about that. So, anyway, I had to throw that in there. I just think it's magic. Yeah.
Good.
And I do this because I'm curious about it. I want to know how to help people make smart decisions with their home equity, make smart investments, just like you. I'm just not certified. I'm only licensed. Yeah. So what is like the smartest thing someone could do to prepare if they are going to be paying capital gains? Are there like trust and things you can do or what? I don't understand all of that.
Yeah. The reality is the IRS, they're usually always going to get their cut to a point, right? So there's incentives like keeping the investment property for longer than 12 months. You can pay a lower tax rate on that. There's incentives like you can defer your capital gains on a property by doing what's called a 1031 exchange. Now, this is the caveat to this. Highly complicated, right? This is where you want to bring in a real estate attorney to talk about it. Your realtor definitely needs to be on board and understand what they're doing as you do, and their financial advisor, right? Because there's rules that the IRS outlines to say, if you sell this property and use the proceeds to buy another property, we'll let you defer the gain that you made on this property and place it into this property. It, you might have heard I said defer. It just means you're not paying that capital gain this year and you're going to defer that into whatever you do with that property in the future. That's a strategy you can use if, say, you are one of those ultra high earners right now and you're in that 20% bracket and you want to defer that capital gain into a future year where you might be in that potentially 0% bracket, but not really because of the gain size, but more likely that 15%. There's a 5% difference there, and that stuff can add up over time. If you're having that discussion, highly, highly recommend you talk with all of your professionals before you sign anywhere on that.
Yeah, I have helped some investors with 1031 exchange. And we actually recently had one that I thought would be a good one, but didn't qualify. They hold the money. You work with a certain mortgage broker that is licensed to do the 1031. They hold the money and you have to find a like and kind property in 6 months.
Yeah. So you have to identify it within 45 days of that transaction. And then you have to close on that property within 180 days. Now, those timelines overlap, right? So really have to be on the ball when you're going through the transaction to know exactly what the next step is for that to defer those capital gains. Sometimes some people might look at the process and say, you know what? I'll just pay the gain. I'll just pay my taxes now and do something else with the assets because you're still tying up those assets into another property, essentially.
Right. And why do people do that? Why do people sell investment properties?
You brought it up earlier, but some people just get really tired of being landowners. As people age, their needs change and their goals change. What is your personal goal and what are you trying to do with this property or this investment? It's the same conversation no matter what you're buying. What's your end game here? Right? Do you want to be 85 years old and doing house calls and painting and plastering? If not, then let's start talking about when do you sell it and how do you sell it and what do you do with those assets? So we definitely see a lot of people that say, this was great. We've made money. It's an investment property. This market's getting a little rough or it's been vacant longer than we would hoped it to be, right? You always have to build in a vacancy rate in your calculations. Most people think, oh yeah, it'll be fine. I'll rent it all the time, 12 months a year. And that's not quite the reality, but that's probably the biggest reason people get out of it. Others, like I said, it could be a health issue, locate, or they need to downsize, or they just need to access the capital that's tied up in this property.
Why do they move the money into a different investment property? To defer, but then also
Yeah.
It's
It could be that they don't
something.
keep owning real estate and maybe they don't
Mhm.
own a house in this location any longer and they'd like to own an investment property in this location. And so they could
Mhm.
move that around a little bit. But really, it's the biggest reason on the 1031s is just to defer that capital gain.
To defer it.
WC.
Do you see people gain wealth using that strategy long term?
If you hold it long enough, you certainly should be gaining wealth, and otherwise, it's a terrible investment. In our experience, we have seen people with very large embedded capital gains, meaning unrealized capital gains in their investment property. In fact, 10, 15 years ago, I talked to a gentleman in commercial real estate, and he had tens of millions of dollars in commercial real estate with very large capital gains. And he was like, I'm never going to sell it now because I don't want to pay the taxes on it. So he had painted himself into a corner on the investment because he didn't want to pay the taxes, which is fair. But at the same time, the investments did really well for him and were generating income for him as well.
Got
So
that.
that's an estate issue at that point.
What about estate planning you don't want to sell when you're gone? Your children or your inheritance are going to have a lot to deal with. You'd be paying a lot of taxes on everything.
Luckily, the IRS is fairly generous when it comes to the estate. So there's an estate tax, and that is a tax that's assessed on an estate that's over a certain dollar amount. And right now it's like almost $30 million. So not a lot of people are actually subject to this. Possible that might change in 2026. But the point to that is most of the time, a brother and sister, their last parent passes away and they inherit the house, the IRS allows them what's called a step up in basis, which means they just take the original cost basis of that house and they just say, instead of the $90,000 that your parents paid in 1980, it's now the market value on their date of death. And so it takes that capital gain and it essentially eliminates it. So if the children want to sell, they're not penalized at that time.
Got that. Okay.
Yeah.
Anything you recommend that someone my age or around this age, what we should do to prepare, like estate wise? Do y'all work on that?
We're not attorneys, so we don't do
Yeah.
estate planning, but certainly part of the conversation, and back to my question is, what's the purpose of this property? For you? If you don't expect to pass away, medium life expectancy is in somewhere around 93 to 95. So is it
Wow.
something that you want to hold it that long, right? Or is this investment better sold and put to use elsewhere in whatever it is you want to do in life? So that's always the first question that we start with. On the flip side, if you were 90 and saying, what should I do with this property? My health is failing, but I'm not going to go in a home. Then there is a technique to say, if you can and afford to keep your expenses, otherwise you're going to save a lot in taxes, or your heirs essentially will save a lot of taxes.
Oh, wow.
You own the property when you pass. Yeah.
Sure. Tell me about, you said we should talk to an estate planning attorney if we want to kind of plan for that kind of thing.
Yeah.
What's a smart way? Because you're helping people build wealth. I love on your website, you have financial well-being on there. How do you help people with financial well-being? And maybe even give us an example of maybe how you've helped people with capital gains strategy or strategies around this.
Yeah. So the first part of that question is one of our core tenets of our mission statement at Momentum Private Wealth is we want to help educate, right? This is a very confusing world when it comes to finances and taxes and the different nuances that go into this. So we definitely wanted to educate the process along the way. If you are making an informed decision, then everyone's better off for it. Some of the ways in which we've helped clients is less on the mathematical side of it and more on how do you feel about it and what is this going to do for you and enrich your life and the life of your children or whatever. It's not black and white, right?
Mhm.
And a lot of people have trouble articulating what it is that they want to do with that property. Don can agree with me that we've seen this light bulb go off in these conversations where someone says, I really had no idea what I wanted to do with this property. But after our conversations and fleshing out what the purpose is and what I want to do with it going forward, I'm crystal clear. I'm going to do this, or I'm going to sell it, or I'm going to keep it. And I'm definitely making this an investment property. And it's going to be a minimum of 20 years. Right. And so it just helps paint that picture. And if someone can go into that and say, These are the consequences of your decision on taxes, whether you pay some now or you defer it, then again, you're just better informed.
So you think people should only have one financial planner, or do you have like more than one?
We do come across people who have hired multiple investment advisors to do what they call sleeve investing, right? So one investment advisor might do US equity really well and another might do non-US, for example. Other times they think that it might just be diversification of the person who's actually managing their assets. The reality is that most investment advisors were a fiduciary, right? So most investment advisors operate under the fiduciary principle. And so unless you're hiring them to do something really nuanced as option trading or swaps, most investment advisors are going to put you in a diversified portfolio with their own tilt and thinking on it. So the reality is most of the time, the people who do that end up just overlapping a lot. So they're not getting the diversification they think they're getting. The downside, though, is it's very hard for one investment advisor like myself to give you my best as my client if someone else is pulling the strings on another part of your portfolio, because they're not working in congruence with each other, right? They're two independent entities. Whenever we do run across that, typically we see one investment advisor fall off in a couple of years, meaning that the client usually decides to just go ahead and work with us moving forward.
Got that. So what are the reasons? Why do people switch to you for a
Mhm.
financial planner? What are some of the reasons you hear?
When it comes to the investment advisory world, the landscape has really changed over the last 10 years, and it's for the better for the consumer. 25 years ago, you were calling a stockbroker and paying $40 for them to buy you a single stock. And that was just the world you lived in. You had no other choice. If you wanted that stock, they were getting their cut. Nowadays, anyone can go on to one of the big brokerage firms and buy it themselves and pay no one to do it. So cost compression has really taken place in this industry. And again, for the better, I think it's fantastic for the client. But more importantly, along with cost compression, is you're actually getting better service and value out of working with a financial advisor. So again, I'm a registered investment advisor. I own my own company and I make the decisions. No one is telling me what mutual fund company or ETF or exchange traded fund we should be buying for any client. I get to choose the best of the best and make that decision. And I get to do that as a fiduciary, knowing that this is to the best of my ability what I think we should be doing for you. You're getting the financial planning side of it. And that's really right back to the questions. It's not the math stuff, right? And it's not the black and white stuff. It's the what do you want to do when you grow up? Or what do you want to do when you retire? Tell me about what retirement looks like to you. Tell me about what you want to do for your kids. Do you want to pay for their college? Do you want to pay for half their college? So there's a lot of conversations that most people don't realize a financial planner is going to bring to the table because they're used to their dad's stockbroker who does nothing but buy stocks for them, right? So the landscape has really evolved into what Don and I like to call more of like your personal CFO. We're here to help you navigate all the nuances of your personal finances, not just pick investments for you.
How do you do that? You can sign up here to set up a consultation.
We love talking to
Mhm.
people. As you can probably picture it, I've hogged the microphone most of this meeting so far, but anyone who wants to sit down and talk to a financial planner, there's no charge to it. And it's very much a get to know you, what are you looking for kind of meeting. And there very much are people who, after the 1 hour, both of us are saying, we're not who you're looking for, right? So we can point you in the right direction, or that's not my wheelhouse. Here's some options that you should talk to. And there are other people that we would say we're very particular with who we welcome to our Momentum Private Wealth family, and we would love to have you on board and work with you on an ongoing basis. I do tell all my clients that I want to work with them forever. I want to go to their kids' high school graduation party in 20 years, knowing that we helped pave that roadmap for them to get them to that point.
We can have the party together because two of our kids will be graduating together.
Let's do it.
Happy.
Yeah.
I did put the website there, and I really appreciate getting to know you and your business more because you don't know what you don't know, right? And it's interesting. So this kind of personal interest what life is like and what you want life to be, I think that it would make a big difference for me. Others watching.
Yeah. And we like to tell people this is a very personal business. It's one of the few businesses in life where we can meet someone and an hour later, I'm asking them how much cash they have in their bank account, how much cash is in their savings. These are just things that people don't normally talk about. If you are going through the process of looking for a financial advisor, you need to like them.
Mm.
Just no is about it, right? You need to be comfortable with them and they need to be comfortable with you. Otherwise, you're just not going to get what you're looking for out of that relationship. So we are very much on board with telling people, it was great talking to you. If we're your first, go talk to 5 more people,
Mm.
right? Because you're going to find someone who is going to fill that niche. There's 100 million different ways to do this business, and everyone does it a little bit differently. You just got to find the person that you're comfortable with.
Got that. Okay, give me a success story.
We met with a gentleman and his wife, and they wanted to do a comprehensive financial plan. This was a couple years ago. And one of his big concerns and questions that he came to the table is, can I retire early? Right. So there's a big discussion around what retiring early looks like. What is early and what do you want in retirement? The sub question to that is, can my wife retire sooner than that? We worked with them every year since, actually, on a recurring basis. Last year, we had the pleasure of sitting down in a meeting and saying, guess what? Looking at the wife and saying, you don't have to go to work tomorrow if you don't want to. Right. And it's a big major life decision that I think when it comes from a third party and it's based on math and some forward-looking estimates on the market, and yada, yada, but just helping them feel comfortable with these major life decisions. And a couple of weeks later, they came back in and she said, I quit. That's it. I worked my last day. And she's now moved into her phase of that life. And he is very quickly approaching his phase of life. We love working with them and it just really makes us feel good. And this is why we do this.
Wow, that's awesome. Want to retire, let the choice to work, financial freedom is definitely high on the list. And I have a lot of friends who want that too.
Yeah.
So they should talk to you. And how
Please.
fast can we get there?
And how fast do we get there? Sometimes it's a little bit of how much are you saving and how much are you spending. So there's not a lot of magic that goes into this, more of just an understanding. So tying this back into real estate, this is certainly the conversation of the day in capital gains is, again, people through the years, they piece together an investment portfolio as they go, and they may end up saying, I've got 4 or 5 investment properties and I just don't really know what to do with them at this point. And that's really where the conversation comes in. And we're saying, how much did you pay for them? Have you done any capital improvements, like adding a pool or redoing your kitchen into designer appliances or whatever? And let's talk about what it is you want to do with that from here. Believe it or not, we have a lot of clients that say, I bought this house and this is my kid's college fund. Great. You have a purpose to this, right? So let's talk about the tax consequences when you need to sell it if you do end up selling it in 20 years, right? So that's really where the meat of the conversation comes in. And it's not something that just a one and done conversation. Most of our clients, we're having this conversation every single time we talk. How do you feel about your investment property? Done being a landlord yet? Nope. Good. It's producing this cash flow for you. And as long as they're content with it, then we're good.
Do you usually see real estate as like the top performing asset for most of your clients?
So anytime you're talking about performance in any investment asset class, it 100% matters on what your time frame is, right? So anytime someone's showing you performance, they have probably cherry picked a time frame that really meets their goal, right? Their presentation. We're never going to talk about performance on our portfolios because we're not investing for performance. We're investing for goals and purpose. We have seen time, right? Obviously, the Austin market was super, super hot a few years back, and people made a lot of money investing in real estate if they got into it at the right time. When maybe 20 years before that, right, it was a pretty slow and steady growth of whatever the market does. You could probably tell me what the general market returned on real estate was compared to something like the Magnificent Seven of the S&P 500 over the last 5 years. Probably not. So there's different time frames where different things are going to certainly outperform. We're really only going to ever be concerned with something that's a long-term 10 plus years which is like, why are you buying this and why are you holding it? And if you're going to try and flip it in 2 months, then cool. That is a world of itself. If you're going to hold it for 20 years, then that's a different story.
Got that. Okay, last question. You've been doing great. Now I want you to be psychic.
Okay, cool.
Okay. And so what are you preparing clients for in the future? What do you think is going to happen and how are you prepping them?
So let's stick to the real estate theme on this right now. The people got really comfortable with very low interest rates, right? So when the Fed has basically zero interest rate policy, they are keeping the cost of money very low and they're trying to spur the economy and the people spending. For a number of years, as you well know, we had interest rates that even dipped into the ones for some people, real qualified buyers, twos, and even threes. If you zoom out over 30 to 40 years and you look at the band of the average on a mortgage rate, that's twice as low as it probably should be, right, on average. So we're probably pretty close to the average interest rate on mortgages on a 30-year fixed right now. Look at a long enough time frame. No one likes it. No one wants to sell a mortgage.
It's not high
But
compared
it's
to that.
the 80s. I think my dad had an 18.5% mortgage for a while, right? So I think the point of that is definitely we're going to see more of a return to normalcy on interest rates. And when I say normalcy is 5 to 6 to 7% on the high side is probably where we're going to bounce around for the next couple of years, right? That's a guess. I have no idea. A lot of this depends on the Fed and the economy, but if things hum along, this is probably where we're at. So you use the price of real estate for that. The price to you is as a consumer, what your monthly cost is.
And the price of eggs.
That's the other thing where I played general inflation conversation is I think the US economy is essentially pretty strong right now, right? The consumer's strong and Americans love to spend money. And so we continue to spend money. I do think there is probably a discussion of what could happen, right? Not this is going to happen, but we could run into a slowdown in the economy. We could run into the recession word where it's just, hey, things are slowing down. Consumers, or when that happens, consumers end up not spending as much money and saving more money. It's just the nature of the consumer in those types of economies, which leads to just more of a slowdown. There's always risk of that. But what I'm telling all of my clients, and this is even from the get-go, is we're not investing for tomorrow. We're investing for 10, 20 years down the line, whatever your time frame is. And that's a long time period when it comes to investing. To throw this back to real estate is if we literally had this conversation today with someone who said, interest rates are high. Do you think it's a good time to buy my forever home? And I said, who cares what the interest rate is on a forever home? If this is your goal and what you're trying to do and accomplish in life, we change the interest rate down the line, or in his case, he's a high earner and it's maybe you just pay it off quicker. But this is your forever home that you really want to buy, right? So the goals have to outweigh the math sometimes. Again, as long as you're making an informed decision on it, then everyone's happy.
I really appreciate you sharing that. A lot of people don't understand that the housing market has been in a recession for 2 years on purpose to help the rest of the economy. And still the prices maintained and went up. That's the message to get out. It's don't wait to build your forever home or to make these moves because long term, there's a lot of people being born and population expanding. There's always going to be this shortage of homes. It's just supply and demand. If we can keep getting that message out and get people to make those smart decisions and to do math, I don't do math. We all need help with math and savings. And thank you. Thank you for today. And thank you for sharing all this with us and your knowledge and your company and your values. I just appreciate conversations like that. I'm here to learn. And I know when I'm here to learn that my clients and the people I know, they also want to know about it. Thank you for your time. And again, I have your website up here, momentumpwn.com. Set up a consultation with Austin and Dawn is on here too right away. Thank you again.
You're very welcome. Thanks for having us on. We love the conversations and like I said, we love talking to people. We're always here.
Awesome. Sounds great. We'll get this recording out to people who wanted to see the recording and could not make it today. And thank you to everyone who joined us today.